Welcome to the Private Lenders Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, thanks for checking out the show. We appreciate it. Today we're talking about capital. The specific topic of capital today is the different kinds of funding available to hard money and private money lenders. Pros and cons of each, depending on your situation. We're gonna dive in. The first one I wanted to start with, because this is basically where the whole industry started, of private lending on any kind of hard asset. Of course, we all do real estate, specifically investment and commercial real estate. Was started because people had some money and wanted to lend it to investors to earn a good rate of return. Lending their own money is basically the foundation of this business, right? Like, that's how a lot of it was, even when we got in the game in 2007, before big organized companies came around with brands and staff and everything else. It was people who understood their local market, the value of investment real estate, understood the legal side of things. Sometimes they'd be attorneys and stuff like that with a few $1 million of their own cash. And that was a lot of the private lending business, was that right there. People wanting to lend money. And that's still, okay, I don't want to say that's still the case. It is still the case to a certain extent, in that, for example, a lot of our personal game plan as time goes on is to lend more and more of our own money personally, and our company's money as well, into our own deals. And as our inner circle mastermind has grown, a good portion of the room, we're about, I think, 4 or 5 meetings in, a good portion of the room are lenders who are just lending their own funds, right? Yeah. What do you think on some of that?
If you're listening or watching this, don't be discouraged if you don't have endless amounts of your own funds to fund your entire portfolio. We don't either. We have a $50 million portfolio, and I'm willing to say that it's not completely funded by us. It's but a good part is, and we're continuing to do that. And we learned early on the importance of this business model and this investment vehicle that is in place. It's not just like a fee machine where, hey, let's go do some deals and make some fees. Great. Like, the goal of this is to lend money out, save that money. There's lots of different income streams in private lending, and reinvest them into your own deals. Like, do the math, right? Do the math. It's, for the most part, if you're lending your own capital out, you should be making at least a 20% rate of return on that capital with pretty limited risk, right? The first mortgage lender typically has the least amount of risk. But let's say you're lending it out at 13.3, give or take, maybe more, depending on the market that you're in. You could churn that money twice a year, right? So 13.3 turns into 13.6, which turns into 19% rate, plus some miscellaneous and junk fees, commitment fees, appraisal fees, other types of fees. Yep. There's no reason that for every $100,000 you invest in this business that you shouldn't make a 20% rate of return. And then you go off the rule of 72, and every 3.5 or so years, you should be doubling your money, give or take, right? Like, yep. 3 years or so, you should be doubling your money. Like, that's where the magic happens. Like, could you utilize your capital into a more active vehicle and, start a different type of business, or invest in flipping houses and make higher rates of return? Sure, you could. But this is a pretty passive investment vehicle that you're investing your money in and making high rates of return. So that's typically, the game plan. That's the big picture goal, to invest as much as your own personal capital into these deals. Because as we start talking about other capital sources that are available, your rate on return is just going to go down, right? So for instance, if you're using other capital investors, and we're going to talk about that here momentarily, but if you're using other capital investors' money, and let's say you're giving out 10% rate of return to them, all of a sudden, instead of making $20,000 for every $100,000 you deploy, you're only making $10,000.
Right. Yeah. I mean, it turns into about a 50-50 split when you're when you're lending capital investors money. So, like, if we are talking about the 3 points up front plus the miscellaneous kind of junk fees, And then on the back end, if you have a 1299 note and you do approximately 80-20 split, so 10% to the investor, 2.99 to you, all in, when you look at like year to year, it works out to be about 50%. So if you're the lender, you make double. And if you're using OPM, other people's money, other people's capital, you make about half, which is totally fine. It's still a very, very good spread. Like it's still a very, very good business model. And like Jason started with, when we started HMB in our 20s, we didn't have capital to put into deals, and we built it over time. And that's cool. And that's been our game plan. And it works that way too. I think that is option number 2. If you want to rank these from like, best to worst, the best case scenario is that you're lending your own funds, responsible for your own money, don't have any investors to answer to or to keep informed or anything like that. That's, ideal. And then number 2 is capital from high net worth individuals, people, small companies, nothing institutional, nothing corporate. That's game plan number 2. And that is a large part of the game plan for people who want to grow a large portfolio. The fact is you just need other people's money, and that's totally cool. Co-lending is a popular name for it. Direct placement, trust deeds is kind of the old school terminology for it. And that's a great way to grow a business as well. We were emailing earlier today with a consulting client who we're doing our 2-day training with, and he's in the process of raising capital, and he was asking about some of the other stuff, the institutional money that we're going to get to, lines of credit, stuff like that, if he should go down that road for capital. And honestly, I think it's just very short-sighted to do so. I know it's work to raise private capital. We know it because we've done it, and we've been doing it for 16, 17 years, investor relations day in and day out. I know. But with that kind of setup, using actual private capital, you're going to control your underwriting decisions, your closing timelines. You're going to set the spread in terms of your own profit margin, what's being paid to the investor, what you're charging, meaning like you're determining your own income. It's not being determined by a third party institution, smart money from Wall Street type stuff, right? So I think if you're looking to be in this business long term and grow a big portfolio and be a full-time operator running a hard money company day in and day out, private capital, it has to be part of the game plan, right?
Yeah. Let's bring up briefly some other types of capital available that we've never used, we don't recommend, but that is out there that we've seen people use. And I think there's more cons than there are pros, but there is obviously some pros on it that we can discuss. But first, let me read to you what Chris wrote to this consulting client, because I think this actually sums up a lot.
Oh yeah, read that email.
Yeah, he asked and said, "Hey, I know you guys don't recommend this type of stuff, but what are specific ways to get institutional capital, warehouse lines?" And Chris's response was, "As far as warehouse lines and selling loans to institutions, we don't recommend going that route. I understand it can appear to be an easy source of funds and less work than raising private capital, but it'll end up being just like being in the mortgage business. No control of underwriting, the closing timeline, and with compressed margins. The best path is to steadily raise capital from high net worth individuals, which we are going to help you do on our next call." So anyways, that's kind of a side note, but here's the thing. Lenders have warehouse lines. They sell loans to institutions. They get levered note assignments through their bank. They get, bank notes. Some of them have funds, leveraged funds, unleveraged funds. And, as a hard money lender, you can determine what works best for you. We'll tell you from experience, obviously, what's worked best for us, because we've already discussed it. That is work best. Yeah, it might be a little bit slower right off the gates to raise capital from one-off capital investors, but we have hell of a lot more control, potentially less risk. It's something that will happen forever. It'll continue to do so, and grow and grow and grow and grow. So I would say that probably there's probably 2 common ways that lenders are doing things right now, either brokering or table funding or closing with their own warehouse lines and then selling off to some of these institutional backed lending partners. That's obviously a common one that they're doing right now. Let's just walk through that process real quick, just so somebody, could kind of understand this if they don't already know. But like, think about this. And if someone's in the mortgage business, they're going to follow along, and it's very easy to understand. And a lot of folks got out of the mortgage business because they didn't want to be in that space anymore. So try not to find yourself right back into that space doing hard money loans and acting the same way. But in essence, you have whatever an underwriting manual that you follow for who doesn't matter, Rock Capital, Templeview, doesn't matter, any of them, right? So it's like, here's our underwriting requirements. If you want to broker the loan to us, if you want us to table fund the deal, if you want us to buy the loan from you after the fact, these are all the requirements that have to occur, right? So, walk through how that process works, right? You get on the phone with a prospective borrower, you determine if they're qualified, you go have them pay for an appraisal. The appraisal takes 2 weeks to potentially come back. After that appraisal's in, you load up the whole file with, loan applications, credit report, the appraisal, bank statements, probably not tax returns, probably don't need that, income docs, scope of work, just lists and lists and lists of stuff. Upload it to them. A few days later, they determine if it's something that they're interested in. If so, they give you, a conditional approval and terms and says, cool, this works. Here's 25 or 50 more items that you have to go get. Get all that, submit that. And if that works, then we'll put that in underwriting. Yada, yada, yada. Weeks and weeks and weeks and weeks and weeks. That's the process. And, if you get that deal closed, maybe that works. Now, 2 things to note. Number one, pros and cons. The cons are you're obviously not going to be able to make as much money on these deals as you can, right? As you would as a hard money lender, right? You're not going to make, the arbitrage on your interest rate. You're not going to make 3 points plus other fees, right? So that's obviously, a big con. It's going to take a long time to close. That's a big con. The pros, if anything, is, and we'll talk about the story, Chris, with the buyback that just occurred.
I have another story too. The pros that it's unlimited. The source is unlimited. The
pro is unlimited, and you probably can get your borrower higher leverage.
Higher leverage, true.
Yeah.
Here's a good story for you about the institutional stuff. I don't think I brought this up yet. I was listening to Kevin Kim's podcast. Kevin Kim, he does a Lender Lounge. It's called the Lender Lounge podcast. Really good one. Check it out if you're interested. He's an attorney at a Jurassic law firm in California. He was on our show a month or so ago. Really, really good podcast as well. And he had on as a guest John Beecham, who is the founder of Torak Capital. John Beecham basically invented the institutional money being in our space. And he's a very sharp guy, finance background, very well spoken, and he knows what he's talking about for the most part. So here's one thing that he said. You're going to be interested in this. One thing that he said when he was talking about bringing that product to market is that private lenders aren't really competing for most of the market with other private lenders because most fix and flip transactions happen with no financing. What you're competing with as a lender is investors who don't use financing because they'd rather use their own cash and make a better margin than to use private lenders at a double-digit rate of return. And so this is how he kind of, rationalized why this product was going to work when he invented it, is that we have to bring a product to the customer. He said that the customer, being a flipper, doesn't really like the financing options. They don't really like a regular hard money lender's terms enough to use that over cash. So can he make a product that they do want to use? Can he make a product that the customer wants? And at the time when they started, rates were low. And so they were single digit with a point or two, very inexpensive, reasonably speaking, like comparatively speaking. At the time, it was cheap. And so the customer wanted it. Okay. I get that. If you fast forward to 2023 and 2024, it's not so cheap anymore. So is that still a great product for the customer? Combine that with the fact that it's slow. It's not quick like a private lender like us. One of the things that we stand out for is that we can close in a couple days, right? If title's in, we can close pretty much. So combine that with today's interest rates and the fact that they're slow. Is it still a product, this institutional money, that the customer wants? Much less so, I would argue. And of course, when John Beecham says it, it sounds, he's very well spoken. So it comes off like, man, that makes a whole lot of sense. And then I kept thinking about it after I was in the car at the time. And after the podcast was over, I was like, well, maybe it's not as attractive, that particular institutional product, as John Beecham portrays it to be. So anyway, just one thing I wanted to throw out there, because I just was at the end of last week and I was listening to that podcast, and it's very relevant to this topic. So I understand why people go that route, sort of. I think a lot of it is short-sighted, which what we were telling our consulting client before, and like I said earlier on this podcast, I think it's just kind of an easy way out instead of doing the work to raise capital that you control, in that it's going to stick around, it's going to be stable, it's going to be with you well into the future. That's the real game plan in this business, raising a fund, whatever the structure might be. Capital that you control is what makes this business work. And you're giving up on that if you're selling your loans, and possibly kind of in between using the credit line stuff, which we can dive into, is probably the last source of capital, right?
Yeah. I'm trying to think of other things related to kind of the institutional side, because like, yeah, I mean, if you're trying to really be a full-time hard money lender and, run this as a business, you're going to have no control over that capital. It makes it challenging to do. And again, like, it's enticing, especially if you're like, well, I need capital. This would be an easier path. And it's like, well, it might be easier to kind of get that capital going up and running, but it's going to be a heck of a lot harder to get those deals through. Right. So maybe it's easier. I don't think it's easier to raise capital that way, but maybe for somebody else, it is easier to raise capital that way, but then they're going to have other challenges kind of along the way. And kind of the, another popular way is, I don't know. I think if somebody's going to take institutions out of this, I think if somebody wants to use some sort of bank facility, I think probably the best way to get a bank facility, which wasn't very popular back in the day, but it's very popular now, is just leveraging your current notes, right? You do a loan for $100,000, you sell 80% of that note to a bank. I don't think the terms are going to be much cheaper than, probably at 8-9%. It's not going to be much cheaper than you can raise capital anyways. You might have a personal guarantee with that note, but in essence, you just do an assignment, to that bank. You write a loan for $100,000. The bank comes in. It's got to be a local bank. Bigger banks probably won't do this. Be a local bank. They, in essence, buy 80% of the note from you, right? So they free up $80,000 of cash. You only have $20,000 of your own capital or investor capital on the hook, and you in essence are able to free that up to do more deals. But I think the game plan moving forward should always be steadily just raise cash. So raise capital, steadily raise capital. You have the most control. God forbid you write a really bad loan or something happens with a bad market cycle. At least you can kind of have a candid conversation with the capital investor and figure out a way out with, like, hey, we're going to take back this property and we're going to turn it into a rental property. And it's not ideal, but like, that's the game plan. Or, you know what? We're not going to be able to get all our, God forbid, not going to get all our principal back on this, but I'm going to do a workout with you where I can, cover the difference to make you whole, or do something, right? You can actually have a real conversation with a real human, for worse case scenarios with a capital investor, right? You guys are partners on these deals, and makes it a little bit more flexible than, I think, kind of going these other routes. You want to end with the story you told me today about that?
Oh yeah,
that buyback, because I think that's a really, really good example of what could happen and does happen more than I think people realize, because people only
Sure.
think of the good stuff, not the bad stuff.
Yeah. So the other thing to be very aware of, if you're selling to an institutional source, is the whole world of buying back loans that you already sold. if you've signed agreements like third-party originator agreements and stuff like that, whatever they're called, that company has you as a lending company sign, there's language in there about buyback provisions that I would strongly suggest that you have your attorney review, because it might be to the extent that you don't want to sign it at all or be in that game, be liable for buying back loans that you already sold. Because guess what? I mean, which loans do you think they're going to make you buy back? The ones you want and the ones that are performing and the ones where the numbers look good? I don't think so. They're going to be making you buy back the problems. It could be $100K, it could be $1 million, whatever that loan amount is. You think you don't have risk, but you do if you sign that agreement. So this particular one, I was talking to a lender from LA last week, and we're kind of overlapping in a transaction. Not going to get into all the details, but he funded a loan. He's an LA-based lender, funded a loan in Philadelphia, immediately sold the paper, $110K loan amount, small deal in our world. He got wind that there was some kind of fraud on the borrower side, and the investor made him buy it back right away. If there's any kind of fraud going on, doesn't matter the reason, doesn't mean the lender did anything wrong at all. Like, his file is clean. It's fraud on the borrower side they found out about later on, or a title related, something like that. He had to buy it back. He had to buy back this problem thing. He was not expecting it. It's not a huge number, but he's not in the controlling private capital business. He doesn't have a deep capital base where he can just buy stuff back. And it put him in a bad spot, even at that small loan amount. So I would caution people who are considering doing that to be very aware of the fact that if they have to buy anything back, it's going to be the worst ones they've sold, right? Because otherwise they wouldn't have to buy it back. And what capital are you using for that? Are you using your own money? Are you putting investor money into something like that? I don't know, but it's a position that we at HMB have never wanted to be in. So, I don't mean to shit on that whole model. I know that people make a lot of money doing that. They put out tons of volume. I'm not shitting on the entire model. I'm just saying that people should be aware of what they're getting into from a risk standpoint, and also just a business model standpoint of not having control.
Yeah, in this case, this deal was 6 or 8 months due. Right? He had sold it. He originated 6 or 8 months ago, and then they found out there was a title claim, and he wasn't actually going to end up being in first position. And because there's a title claim and everybody got notified, they're like, okay, well, we're not going through that. The lender who he sold it to, which is the smartest person in the room, right? Like, we can go through that at another quote unquote. It's like, I'm not taking the risk on this. You're buying this thing back, or I'm going to shut you down, and I'm going to sue you for it, and you're never going to be able to sell another loan to me. And all the, you know what I mean? Just like that. And the originating lender, Hard Money Company, didn't do anything wrong, except that he got stuck with a fraudulent case that he had no idea was fraud. He got defrauded by the borrower at a later date, and now he's stuck buying that back. And if you're not doing 120 or 25% title insurance on your deals, okay, well, he's buying back the principal. So just the principal amount, or let's say he's getting a title claim at a later date. Like, that title claim is only going to pay out principal. It's not going to pay out any other, costs associated with that. Legal fees, costs, back due interest, things like that. So buyer beware. I guess we can end with that.
Yeah, for sure. No, important topic though. Important topic for anybody in the business, lending their own funds, other people's money, just getting into it, whatever it may be. I hope this podcast helped you out, made you more aware of the different sources of capital available to you. I hope to see you guys here next time on the Private Lenders Podcast. And also, if you do want to step it up and get around other like-minded individuals lending private funds day in and day out, check out Hard Money Mastermind, innercircle.com. And we'll see you guys here next time.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.